everybody's heard of a breakout in a market, and it's a common market movement as markets transition from trends to ranges and trends again. The only way that happens is if price breaks out to trend. And in this video, we're going to talk about a specific breakout, the opening range breakout. And we're going to show you how you can implement this technique in your own trading. First off, though, this price pattern guide that I talk about, I put this together for you guys, and it's had some great feedback from a lot of people who've grabbed it. It's free, so just take a second to hit the link above or below in the description. All right, let's get started here. Now, the opening range breakout, the ORB, it's nothing new. It's been around for literally decades, and it's simply a trade that's taken above or below the opening range of a market. Now, some traders, they're going to use a predetermined price point, something Toby Crabel calls the stretch. And that's a calculation from the previous trading days. And I'm going to cover that later in this video. And others are going to use the breakout itself. They can use price action at the range extremes or the reactions after the breakout. And there are a few ways we can define the range. And we're going to take a look at three. And the most basic form of defining the range is to use the high and low of the previous day's close and the high-low of the first 30 minutes of the open. And this is a great method because it takes into account any gaps in price that's going to happen between the two trading days. And there are times that gaps are going to get filled after the opening bell. And if you enter a breakout and you're not aware that gap is there and that gap gets filled with you in the opposite direction, it can be a painful trade. So knowing that the gap is present and the distance of the gap, that's going to help you better manage your trade, or maybe not even take a trade. Now, Forex traders, they might want to mark off the high and the low of the Asia trading session. And that's going to determine the opening range, high and low, as you go into the London session. And here we've marked off the low and the high of the first 30 minutes of trading on the ES, and we're ignoring the previous day's price action. Now, there are a lot of other methods to determine a range. You can use 5 to 6 daily inside bars, or narrow range 7 bar, where the daily range is less than the previous 6 trading days. So now we've covered a few methods that you can use to define a trading range. Let's take a look at some breakout strategies that you can begin to backtest. Now, I'm not going to cover all scenarios because there's so many things that can happen. But what we're going to talk about here can really form the foundation for you to begin to design your own trading plan. And the first one, it's just a basic opening range breakout strategy. And here we're going to use the range definition that we used the previous day's close, high or low, and the first 30-minute high or low. And this can be adapted to all the opening range definitions that we've talked about. And I purposely chose a stock where the open had a low that was lower than the low of the previous day's close. So this is where you're going to have to adjust and use the lowest low or the highest high, depending on how price action unfolds. And this stock for Pinterest was also featured in a recent options trade of the week, and you can check out that video at the link above. So the open put in a low that was lower than the previous day's closing candle low. So this forms the bottom of the opening range on this particular chart. So price breaks out of the high of the 30-minute range, falls into the support zone for a 23-cent drop before taking off to the upside. So we can measure the size of the range, the gap distance, and project that from the top of the 30-minute range in this example. The price hits that target for $1 per share. Now, if you trade in shares of 100, because you also look at the option sides of things, you just made gross $100. And your stops can be in the middle of the range depending on the size of the range. And pullbacks after a breakout back into the range, contrary to popular belief, does not automatically mean the breakout trade has failed. In this example, the better stop would have been under the low of this red candle that formed the high of the range. Using price structure, or the ATR for your stop, is a viable approach to any strategy. And while this opening range breakout target was made, some are not going to. So you're going to have to explore other means of managing your trades and taking your profits. And let's take a look at some target objectives you could use. You could use an ATR reading for your profits, 1 times or 2 times or 3 times the current ATR. You can look to find stalling price and a range structure forming that will signal a loss of momentum. Any obvious momentum candle is going to give you fast profits. So consider placing your stop halfway inside that type of price move. And it's really vital to your trading plan and to your future success that you include how you're going to enter your trade, your exits, your risk, and exactly how you define your ranges. Now let's look at a London session breakout for FX traders. And in this example, we're just going to use the 15-minute pound against the Japanese yen chart to show how this strategy works when the market just changes sessions. Now keep in mind that in Forex, the Asia session is generally muted price action, and the London session is where a lot of the larger moves can happen. Now this large area between these horizontal lines that highlights the high and low price range that formed during the Asia session. So as price moves into the lower end of the range, we can anticipate a breakout to the downside and place a sell stop order several pips below. And our stop loss can be a 2 times ATR, which was about 20 pips in this example. This is our price target, which is the distance between the high and the low of the Asia range. And this trade hit target for 50 pips. Now, other possible ways to manage this trade could have been just to trail your stop above the highs of each candle once price started to break to the downside. And as mentioned, we always want to be careful of momentum candles, not only for profits, but for risk, because they can form an exhaustion move that will then see price snap back against your position. A 30-minute opening range breakout. Let's take a look at a popular trading instrument at Netpicks here, and it's crude oil. And we're going to look at it on the 5-minute chart. And I want you to remember that the same concepts that you're going to learn here, they're going to apply to other range definitions that we talked about. So in this example, we're going to dig into price chart patterns that I use on a regular basis in my own trading and the entry points that exist from them. Now here is the low of the range, and we could anticipate the breakout and place a resting order to sell when price breaks the range. But this is not what we're going to do in this particular strategy. So after a leg down in price, we'll call it the impulse move. We're going to look at a pullback, which is the corrective move. And we're using the trend line break or a break of the inside red candle only as a trade entry. It's the rhythm of the market that changes. Here, price forms a double bottom, and we can consider the leg into the bottom as a pullback. Again, trade the trend line break for the entry. Price moves back inside the range that we had defined earlier. We get a pullback, and we can see an obvious reversal candle into the support zone. That's the green line. The trend line break is our entry. Price breaks the range high, forms an up thrust, which is a failure test entry that I've talked about in other videos. You can look above in a link. And you can trade the break of the lows of the obvious candle reversal. You want to keep the stop loss order placement and the profit targets very simple and repeatable. We've talked about those. Again, use the ATR as a means for both. It's a great start, and you can refine these as you gain more trading experience. Now, I promised the stretch trade entry. And again, this is from Toby Crabel, and it's a mathematical way of determining your exact price for trade entry. And you can use it for any of the plays that we discussed earlier. All right, take the high minus the open and the open minus the low for each of the 10 previous trading days. Take the lowest number, add them up, divide by 10. And you can see an example here, the high minus the open minus the low. And you do that same calculation for the previous 10 days, and you can see that the 16 cents is the lowest number. So we're going to assume for this example that all days had a low value of 16 cents. So we add them all up, divide by 10, and of course we're going to get 16 cents. So you would set your entry 16 cents above or below the range. You can see the example here. And for those that are looking for an objective trade entry, this is about as an objective entry as you can ever get. So let's wrap this up because we've discussed a lot of stuff here. So here's the Cliff Notes version. You have several ways to define your opening range. You can use the high-low of the previous day's close and the high-low of the current trading session, the 15 or 30 minutes. The Asia session in Forex can offer some great ranges that you can trade when the London session opens. The first 30 minutes of the session, you can use that as well. There are 2 strategies that you're going to find useful when considering trading the opening ranges. One is to trade the actual breakout or look for signs of pending breakouts and position before the break. It's my favorite. You can use simple price action and price patterns to trade after the break. Your stops and targets, well, they're going to depend on the trader. But I want you to consider ATR stops and targets because they use the volatility of the market and it's objective. You can use the distance of the gap as your price target. And I want you to ensure that you do not ignore momentum in your favor as a means of removing risk from the trade or just taking your profits. So thanks for checking out this video. Hope you subscribe below and make sure you grab that free price pattern PDF that I spoke about earlier. Thanks.